The US dollar and the euro are two of the most important currencies in the world. Right now they are close to parity. This means that one US dollar is worth about 1 euro. This is a significant change from recent years when the US dollar has generally been stronger than the euro. Several factors have contributed to the recent convergence of the two currencies. These include economic data, interest rate differentials, inflation rates, central bank policies, and market sentiment. Let's take a closer look at each of these factors. The US economy is currently performing well. Job growth is strong and consumer spending is high. This has led to increased demand for US dollars as businesses and investors around the world seek to invest in the US economy. The Eurozone economy, on the other hand, is facing some challenges. Growth has been slower and inflation is higher. This has made the euro less attractive to investors, leading to a decline in its value relative to the US dollar. Interest rates also play a significant role in determining exchange rates. The US Federal Reserve, or Fed, has been raising interest rates more aggressively than the European Central Bank, or ECB, in recent months. This has made it more attractive for investors to hold US dollar-denominated assets, such as US Treasury bonds. As investors buy US dollars to purchase these assets, the demand for US dollars increases, driving up its value. Conversely, the lower interest rates in the Eurozone have made euro-denominated assets less attractive, leading to a decline in the euro's value. Inflation is another factor that can impact exchange rates. When inflation is high, the purchasing power of a currency declines. This can lead to a decrease in demand for that currency, as people seek to hold currencies that are better able to maintain their value. Inflation has been a bigger problem in the Eurozone than in the US in recent months. This has contributed to the decline in the euro's value relative to the US dollar. Section 5. The Fed versus the ECB, a monetary standoff. Central bank policies such as interest rate decisions and quantitative easing can have a significant impact on exchange rates. As mentioned earlier, the Fed has been raising interest rates more aggressively than the ECB. This is because the Fed is more concerned about inflation, while the ECB is more concerned about supporting economic growth. The different policy priorities of the two central banks have contributed to the divergence in interest rates, which has in turn impacted the exchange rate. Section 6. Reading the tea leaves. What do the experts think? Market sentiment or the overall mood of investors can also influence exchange rates. When investors are optimistic about the US economy, they are more likely to buy US dollars, driving up the currency's value. Conversely, when investors are pessimistic about the Eurozone economy, they are more likely to sell euros, leading to a decline in its value. Currently, market sentiment seems to favor the US dollar. Many analysts believe that the US dollar will continue to strengthen against the euro in the coming months. Section 7. The decline of the dollar, the rise of alternatives. In recent years, there has been growing talk of de-dollarization. This refers to the trend of countries and institutions reducing their reliance on the US dollar, particularly in international trade and finance. One factor contributing to this trend is the emergence of alternative currencies, such as the Chinese yuan and the euro. Another factor is the growing use of digital currencies, which could potentially reduce the need for traditional currencies like the US dollar. Section 8. Digital currencies, the future of money. Central bank digital currencies, or CBDCs, are digital versions of fiat currencies issued and backed by central banks. Several countries, including China, are already developing and piloting their own CBDCs. The widespread adoption of CBDCs could potentially have a significant impact on the global monetary system. Some experts believe that CBDCs could challenge the dominance of the US dollar, as they could facilitate faster and cheaper cross-border payments, reducing the need for US dollar-denominated transactions. Section 9. To buy or to sell? That is the question. So, what does all this mean for investors? Should they buy US dollars or euros? The answer, as always, is, it depends. Investors need to carefully consider their own individual circumstances, risk tolerance, and investment goals. If they believe that the US dollar will continue to strengthen against the euro, then buying US dollars may be a good option. However, if they are concerned about the potential risks associated with a strong US dollar, such as a decline in US exports or a trade war with other countries, then they may want to consider diversifying their portfolios by investing in other currencies including the euro.